When the Reserve Bank of Australia lifted interest rates by only 0.25% this week, it generated headlines around the world. Al Jazeera said, Australia breaks with global trend, slows interest rate hikes. The Financial Times said it was a smaller than expected rate rise. Reuters described it as a surprise move. The Wall Street Journal was also in uproar, writing, most economists expected a further 50 basis point increase. And Bloomberg said the RBA had surprised the share market, causing the currency to tumble. What made the RBA's move more dramatic was the Reserve Bank of New Zealand hiking interest rates by 50 basis points the very next day to 3.5%. Its fight with inflation was clearly not over.
In the moment, what it's balancing is the risk of going too far versus going too slowly. And at the moment, it sees the risk of going too slowly as its biggest source of regret, in the sense that it just may not do enough and it may have to play catch up later on and potentially have monetary conditions tighter for much longer than will be ideal.
In the RBA's defence, it meets 11 times a year. The US Federal Reserve, led by Jerome Powell, and the Bank of England, led by Andrew Bailey, meet 8 times. And the Reserve Bank of New Zealand, led by Adrian Orr, only meets 7 times. So in some ways, the Reserve Bank doesn't need to lift rates as aggressively as these global peers because it holds more meetings.
It remains to be seen what future increases will be over the coming months.
Former RBA Governor Bernie Fraser, who led the RBA from 1989 to 1996, agrees with Governor Lowe's cautious approach to interest rate tightening.
So the Reserve Bank here has taken quite a number of measures. There'll be lags before they work through the system. And it's just sort of being cautious. It's doing something and seeing how it works and then seeing whether further changes are needed and whether they need to be bigger or smaller changes. And that depends upon the effect of the measures already taken, but also on changes in future circumstances around the world.
Treasurer Jim Chalmers this week kept up his gloomy rhetoric, saying the world economy had deteriorated in the past month and the threat of a global recession was looming.
The balance when it comes to some of these major economies, the likelihood of recession has tipped over from possible to probable in some of these big economies, which are very important to us. I've tried to be upfront with Australians about that. The OECD, the IMF, the World Bank and others have said that they can't rule out a global recession, and that obviously has implications for us. You know, we wouldn't be spared completely a downturn in the US or in the global economy for obvious reasons.
These comments were echoed by the chief of the International Monetary Fund, who gave a speech this week urging global policymakers to take action to avoid a recession.
All of the world's largest economies are now slowing down. The euro area is severely affected by the reduction of gas supplies from Russia. China suffers from pandemic-related disruptions and a deepening downturn of their real estate market. And while the US still has a fairly vibrant and strong labour market, momentum is slowing down.
The IMF expects global output to shrink between now and 2026 by $4 trillion US. That's the size of Germany's economy.
Our world economy is like ship in choppy waters. We need all the wisdom we can muster to steady the ship and navigate through what lies ahead. In less than 3 years, we lived through shock after shock after shock.
One of the big shocks hitting Australia's economy is the decline in property prices and rising interest rates. The Reserve Bank expects property prices to fall 10% from peak to trough. On Friday, the RBA released the Financial Stability Review, a document that it publishes every 6 months which outlines the risks facing Australia's economy. This time, there are 3 major risks. First, the global economic downturn. The RBA says global economic growth is expected to slow, although the risks facing different regions depend on existing vulnerabilities. many households and businesses built up large savings buffers during the pandemic, which will assist them in facing the more challenging economic conditions. Second, rising inflation and interest rates. Higher interest rates will increase borrowers' debt payments. A small share of borrowers with lower savings and higher debt are vulnerable to payment difficulties. As a result, housing loan arrears rates are likely to increase in the period ahead from currently very low levels. And third, cyber attacks. The risk of cyber attacks is elevated. There have been further high-profile cyber incidents in recent months, including the recent Optus data breach. A significant cyber event could undermine confidence in the financial system and have systemic implications. Next week, the key economic event is on Wednesday, when RBA Assistant Governor Lucy Ellis speaks at a banking conference. And overseas, on Friday, China will release its inflation numbers for the month of September.